Welcome to Conversations, a weekly audiocast featuring interviews with leading investment strategists and recognized financial professionals. Brought to you by the Market Technicians Association.
This is Conversations, the official MTA podcast series, and today's guest is Mark Dibble. Mark Dibble joined Fidelity Investments as a technical analyst in March 1994. Prior to Fidelity, he was a vice president of Morgan Stanley in New York, providing technical research to the global equity derivatives and equity research departments. Before joining Morgan Stanley in 1984, he did technical research for Cohen & Company in New York. Mr. Dibble holds a BA in economics from Trinity College in Hartford and has 29 years of investment experience. Dibble's approach combines the traditional pattern recognition discipline of Edwards and McGee with momentum and sentiment indicators. He works with Fidelity equity portfolio managers, analysts, and traders, and focuses on U.S. industrial, technology, telecom, and utility sectors. He has portfolio oversight on the Technical Research Pilot Fund and is a member of the Market Technicians Association and was named Institutional Investor Best of the Buy Side in 2002. Welcome to the program, Mark.
It's great to be here. Thank you so much, Lance.
Well, tell me about your background. What attracted you to the financial markets?
Yeah, probably a lot of luck involved. So I was always interested in the stock market from a young age. A friend of my father's was a stockbroker and just got me interested in how the stock market worked at a very young age. I happened to be a guest of his on the floor of the New York Stock Exchange in 1979, I think it was. It was great to get back there for the MTA event a year and a half ago, and boy, has that place changed. So I grew up at Cohen & Company, as you mentioned, and was fortunate enough to have 3 summer internships while I was in college. And Cohen at the time was a pretty small place, and I was basically filling in for people while they were on summer vacation at a clerical level, and was exposed to a lot of different parts of the firm and a lot of different parts of research, and kind of finagled my way into the research department, and had an internship with an old point figure analyst, Rick Akel, who was at Cohen & Company at the time. And he happened to have a job opening right as I got out of school. I was a class of 1983 from college. You know, the economy wasn't doing too well. I was very fortunate enough to have a slot right out of school at a good firm.
So you're now at Fidelity, which is famous for many things, one of them being their chart room and their technical analysis. So I'm excited to pick your brain and get an inside look. How is technical analysis and research incorporated as part of the Fidelity investment process?
Yeah, so Fidelity is like a university. We've got all these different ways of looking at the world, and the 3 big are quant, technical, and fundamental. We have a huge fundamental staff and a pretty big quant staff now. So technical has been around for, actually, it's even older than the firm. It was the firm was bought by Mr. Johnson, the current chairman's father, in 1943, and even before he bought the firm, he had the chart room and was interested in charts. So there's a long tradition of it here, and I like to think that we're kind of a check on the fundamental system, or reality check. I think the managers who use the technical research the most use it for either idea generation or risk management. We spend a lot of time finding bad charts within the Russell 1000, so we probably generate more sell signal in the stocks that matter to an institutional portfolio manager than certainly the fundamental brethren internally or on outside the firm. So a lot of the portfolio managers here who use this, they don't talk about it openly, especially outside the firm, so it's kind of a hidden resource. And I'm always shocked that people don't know about the technical research effort in the chart room who are outside the firm, because it's kind of a secret hidden resource. At least we're not doing advertisements in the print or electronic media like some of the fundamental analysts are, in the tradition of Peter Lynch doing kicking the tires and modeling stocks and getting to know the management. So that's the short answer.
What is the pain trade?
Oh, I love it, the pain trade. I always like to think what would hurt the most number of people, what wiggle in the market would hurt the most number of people. I think it's a very intellectually satisfying question to ask yourself. It's something that I probably learned a little bit from Carol Sokoloff, who is the proprietor of 13D Research, who is a contrarian investor and has been for many decades. Some of us here at Fidelity like to attend the Fraser Contrary Opinion Forum, which is an annual conference up in Vermont with 50 years of history about thinking kind of differently about the investment question. There are a lot of technicians involved in that as well. So the pain trade is the move in the market, which would hurt the most number of people. And it's not necessarily up or down. Sometimes the pain trade could be sideways, but I think it's a very useful thing to think about because it prepares you. It often happens, so the pain trade will often play out. So if you can think about it and be prepared for the pain trade actually working, I think you can be ahead of a lot of investors and hopefully add value to whatever you're trying to do.
How do you, once you determine the pain trade, how do you position yourself for it?
Yeah, good question. So just in terms of the sentiment toolkit, I bucket all the sentiment indicators into either market-derived or subjective. So market-derived would be, the call-put ratio or anything else you can put in a spreadsheet and model chart. And then the soft ones, the subjective ones, are often more interesting, and I think it takes a lot of experience to kind of get your arms around that. It's something that they don't really teach in business school, and I think these lessons often come through being on the wrong side of markets or moves. So, and we all, Fidelity is a big place. There's the pain trade and using contrary opinion can often be accomplished without leaving the building, if you will. It's a big place. So, so how do you implement it? I mean, typically it's avoiding things that or there's a crowded long, or looking at things in a fresh sense where there's neglect, if you will. And again, there are lots of different ways of measuring neglect. Let me just throw out a few examples. No one covers the stock, and the stock is acting well, both internally as well as on the street. Anyone who has a Bloomberg terminal can use the ANR function to see how the sell side is positioned with the buy, holds, and sells. And I typically bucket the holds with the sells. I look at short interest. We look at call-put ratios at both the macro level, which is very much in the public domain. We look at call-put ratios on about 55 indices and ETFs, which have liquid option activity, and then we look at short interest. So.
Okay.
But even in a more subjective way, it might be magazine covers, it might be Barron's covers, and sometimes it's actually what is not being said. Like something big is happening in the marketplace, and no one's talking about it. And what is not happening takes probably more experience than the stuff that's in your face, in your inbox, or on the cover of a magazine.
Fidelity has something called a fat pitch chart. Is that a baseball analogy? What can you tell me about that? We don't.
Yeah, thank you. I haven't invented too many things, but I like to think that that's one of them. So the Fidelity Fat Pitch chart. Let me back up. A lot of the portfolio managers here don't like buying the new highs list. They don't want to buy the breakout. They feel like everyone looks at the cost bases of every stock on in our system, and you don't want to be sitting there with the highest cost basis. Although that might be the right thing to do. For something that's persistently strong, buying a breakout is much better than not being there at all. So with that said, people want to buy pullback. So the Fidelity Fat Pitch chart is a bullish longer-term chart. Say the weekly 3, 5, 7-year chart is bullish, and there's some kind of dislocation short-term, which creates pessimism in the market, as measured by all the stuff we just talked about in terms of the contrary opinion. The highest on my list is a call-put ratio based on open interest of options. So that is been fertile territory in the last few years because we've had so many pullbacks that have, kind of increased the wall of worry, and it seems to happen on ever smaller pullbacks. So we had two 20% corrections in the market where you had some really big pessimism extremes. The recent 10% correction in some of these indicators traded the same amount of pessimism that double the decline took in the summer of 2010 and 2011, at least at the macro level. But the Fidelity Fat-Pitch chart obviously is an individual stock call. It's not a macro call.
Okay. And you have something called the best chart in the world. Can you describe the best chart in the world?
Yeah, so I think one of the roles of technical analysis, especially in a big institution, is almost to play the role of the Shakespearean fool. That is, the person who can speak the truth to the king without getting his head lopped off. So, or to put it another way, technical analysis is a great way to have people cause people to think differently about the investment problem. Everyone is in their little style box or their spreadsheet or their model, and everything's to 3 decimal points, and everyone's a genius. So if you can make people think differently about the problem at hand, I think you can hopefully add value to the investment process. So two things that I do that accomplish that are to take the name and the symbol off a chart. It's a great way to remove any kind of intellectual baggage you might have, any behavioral anchoring on a stock or an index or whatever by taking the name off. Now, a lot of people can guess it if you're picking something like the 10-year yield or the S&P 500 or the Dow or Apple or something. You can guess it, but and the other way to make people think differently about the problem is to put the chart upside down and invert the scale.
Huh.
And often you have to take the name off it as well. But if you can get someone to be bearish on a chart that's upside down, maybe they'll be bullish on it. So it's a bit of a trick. It's also fun too.
How do you use the sell side, and how does Fidelity's technical research differ from the rest of the street?
Yeah, that's a good question. So one of the advantages of working at Fidelity is we've got a lot of resources, be it Bloomberg terminals or software packages. And the other one is we can sample some of the best minds in the industry on the sell side. So I probably, I think the longer you've been doing this, probably the less help you need from the outside world. The most extreme example is one of our young analysts in their late 20s who are starting to look at industry for the first time, probably need a lot of help, and they want to look at all the sell-side models and maybe incorporate some of the best ideas of those models in their own work. If you've been doing it a long time, I think I actually might be the oldest analyst at Fidelity. I'll be 52 in December, so I'm at the point now where I've been doing it longer than some of the younger analysts have been alive, or I could be their father, which makes me feel pretty weird because I still consider myself a young person. But getting back to your question, I'd like to bucket any sell-side analyst into 2 buckets: pure alpha generators, people have just gotten it right or been a lot more right than wrong over time, and then people who do things that I can't do. It's either a way of looking at the world, or it's a proprietary data set, or it's some model that they can prove has added value. So, and those are pretty different buckets. I guess ideally, you'd like to be in both those buckets, and if you're in neither, then you got a problem. At least a problem with me.
Would it be a career problem as well? No,
not at all. Because as I say to a lot of the technicians selling into Fidelity, it's like, we're not your core group. It's the other 99% of the universe that are either investing in stocks as portfolio managers, or they're analysts, or they're traders, or they are managing people or investment processes, CIOs in the world. So we're probably not your strongest target if we're actually doing technical analysis ourselves.
Who is your audience?
It's funny. Having gone from the sell side to the buy side, the audience goes from anyone who will hopefully listen to you or pay for your product to a very small group of people. So I think Fidelity's got about 38,000 employees. The audience here is actually a very small subset of that. It's people who work at FMRCO, the management research company, who are analysts or portfolio managers, and kind of the cream of the crop, if you will. The most targeted audience are the 50 or so people who run diversified funds and the 50 or so people who run sleeve funds, that is industry or sector-specific funds. That's our target audience.
So it's essentially traders, portfolio managers?
And analysts.
Okay.
But the portfolio managers are kind of the most important, and they poll the portfolio managers twice a year and ask them, do the analysts, and this is all analysts, not just technical analysts, do they add value? Do you use them? What would you like to see different from the technical analysts? So it's something that's quantified twice a year, not dissimilar from any other investment organization, including the sell side. These 360 polls that everyone does at least once a year. It's pretty normal.
We're recording this interview the week of the elections. We had a 300-point move in the Dow this week. Which market do you see giving the strongest signals right now? Yeah,
so one thing I'm seeing is it goes back to the anomaly, and that is some of the dividend-yielding stocks not acting well. They're not. They've been both offense and defense for 2 or 3 years. And they certainly weren't defensive on the big hit in the market yesterday. So that's just jumping out to me, particularly the large electric utilities. I'm somewhat reluctant to mention any symbols because I think that might get me into trouble. But some of the
clients always looking over your shoulder.
Yeah, bread and butter. Large cap utilities yielding north of 4%. The kind of charts look pretty similar. So those breaks are pretty ugly, and it's at a time where the interest rates really haven't backed up yet. I think the 10-year was up pretty big yesterday. So that jumps out to me as everyone's worried about Apple because it's down 20% or more from the high.
Can I back you up? So you said utilities broke down, being a defensive sector?
Right.
So what are the implications of that? That should be a flight to quality, right? I mean, shouldn't
well,
when things are
breaking
breaking
down,
I don't know.
I don't know the reason, and when I do my spiel on technical analysis, I like to think that fundamental people deal with causality, and technicians deal with timing and selection, or what one of my colleagues calls synchronicity. That is, like things happening at the same time. So this is kind of a curveball because you'd expect the utility average to do better in a big down day. Now maybe I'm putting way too much weight on one day, but some of these electric utility charts I think look dreadful, and maybe that is a harbinger of kind of the safety trade not working after working for a long time.
All right. Well, our time has gone quickly. I wanted to add here that you have several speaking engagements coming up. So those listening, you are speaking at the MTA chapter meeting in Boston on November 28th, and you will also be a guest panelist at the MTA Symposium in April 2013. Are those dates both correct?
That's correct, and thanks for mentioning that. I think I've been a member for 22 years and started going to the MTA meetings in New York in the 1983, and remember we're sitting near Arthur Merrill and some of the luminaries of the MTA, some of the founding members, and it's great to be contributing back to the organization and after all these years.
Excellent. Well, is there anything you'd like to add before we go, Mark?
No, I think I'm all set. I really appreciate the time, and hopefully I've stimulated someone's thought process, and look forward to meeting you and seeing a lot of the folks at the upcoming MTA events. Yeah,
this is a lot of fun. I appreciate your time. Today's guest has been Mark Dibble, and that concludes today's MTA podcast. From LexingtonCapitalLLC.com, I'm Lance McDonald, together with recording engineer Shane Skwarak at the MTA, reminding you that price is always right.